Hey everyone, and welcome back to the Rich Habits Podcast, question and answer edition, brought to you by Public.com. These are our Thursday episodes where every Thursday we sit down and we answer your questions as if we were in your shoes going through whatever you're going through. You can ask us questions via email at richhabitspodcast@gmail.com, Instagram DMs at Rich Habits Podcast, or just join the Rich Habits Network. Link in the show notes to learn more about that 7-day free trial, and always get your questions answered because we host those 2-hour weekly live streams every Tuesday night. Robert, I'm excited for this episode. We've got a ton of cool questions to answer. And man, we're getting really close to Thanksgiving and the holidays. It's snowing here in Nashville. I feel like this year just like flew by us.
It has definitely been an amazing year for us in the Rich Habits Network and our entire ecosystem. And I just love seeing all the cool new things that we have going into 2026. And these episodes have really grown, and I just really enjoy making them.
Now, before we get started, Robert, it's always important to remind people that the only way they're ever going to be able to retire is if they have a nest egg that's growing for them over time. So they don't have to always trade time for money. That nest egg supports their lifestyle via that portfolio income.
And the easiest way anyone can begin investing towards their future is on Public.com. They make it incredibly simple to build a multi-asset portfolio, including ETFs, stocks, bonds, crypto options, and more. They also offer industry-leading yields of up to 3.8% APY for that emergency fund.
And for a limited time, you can earn a 1% match on all IRA deposits, IRA transfers, and 401k rollovers. It's $1,000 of free money for every 100,000 you roll over into their platform. I know you guys have a couple 100,000 from that old 401k, that old financial advisor you haven't talked to in 18 months. Roll that money over and get your free match.
And fund your account in 5 minutes or less by heading to public.com/Rich Habits to claim your 1% match today. Paid for by Public Investing. Full disclosure in the podcast description.
So our first question comes from Aaron C. via email. Again, richhabitspodcast@gmail.com if you have a question. Aaron says, "Hey, Austin and Robert, I'm a big fan and longtime listener of the show. Thank you for everything you're doing to make finance approachable and empowering for all your listeners. I have a question about how much my family should spend on a car. We're expecting our second child and need a bigger car." Well, first off, second child, bigger car. I think a lot of these cars come with 4 seats, so we'll see, but just maybe pump the brakes, literally and figuratively, as it relates to that. But let's assume you do need a car, so let's keep rolling. Aaron says, "My husband's 38. I'm 30. We bring home about $120,000 a year, so I can stay home with our son. Combined, we have a net worth of about $450,000, roughly broken out to $250,000 in savings and investments, $65,000 in our retirement accounts, $110,000 in home equity, and $17,000 in cars bought with cash. We also have $5K in our 529 for our son. We're looking at a 2024 SUV to last us until the wheels fall off. We have set aside $35,000 for the car purchase. However, I feel guilty spending this amount of money on a vehicle because I've always bought the cheapest thing that would fit our needs. Is it too much of our overall net worth to have tied up in a depreciating asset? Any advice you have would be greatly appreciated." To answer your question, I do not think it is too much to have tied up in a depreciating asset. You have about $500,000 of a net worth. You're making $120,000 a year, which means you guys are probably investing anywhere between maybe $15,000 to $25,000 of your income on an annualized basis. Let's even say the $35,000 car purchase will depreciate by 50% in the next, call it 3, 4, 5 years. Your current investments with your current net worth and what you're going to invest over that period of time will more than offset that $35,000. I think the $35,000 is a very fair purchase. I wouldn't feel bad about spending that much money on a depreciating asset in your specific circumstance, but just make sure you actually do need a car. I don't know what you're driving right now, but 2 seats in the back, 2 seats in the front, family of 4, that could work. Now, if you have family of 5, 6, and 7, obviously you would need the van or upgrade to a larger vehicle. You mentioned some sort of SUV here, so that does make sense. But to answer your question, $35,000 seems pretty appropriate.
Yeah, I agree. And I think Austin's breakdown is really important to understand that it's in line with where your net worth is. And the only thing that I'll add to this, my general rule of thumb when it comes to purchasing a vehicle is, If you're going to get a new vehicle, I prefer leasing. If you're going to get a used vehicle, like in this instance, then I think it's totally great to just go ahead and buy it. Seems like you want to pay cash for it versus financing it, which is great as well because, rates are pretty high right now. But I think it's totally in line with your net worth and how much you guys are making. And I totally respect and appreciate the fact that you're already looking at used cars because so many people just want to go in and get the shiny new car, not taking into consideration all of the depreciation that happens over a few years. So that's my take. I think you guys are spot on. Get the used car, get rid of that first year depreciation, try to find one that fits the safety and all the elements and aspects that you want for your family and your growing family. But I think it's a great idea.
There's a lot of different ways that you can go about purchasing this car, but I think to answer your question, the 35,000, I think it's a perfect amount. Even if you said maybe closer to 40,000, 45,000 maybe. Robert, do you have like a general framework as it relates to like how much car someone can afford?
Yeah, I don't really have framework as far as exact amount versus their net worth, but I would say this. They're already considering in this instance looking at a 1-year-old car. I would do the math and really look at a 2 or 3-year-old car because I feel like most new vehicles right now that are in that 2-3-year-old range depreciate the most in the first 2 or 3 years. And therefore you're getting the better part of the deal. And a lot of times you can find 2 or 3-year-old cars that already have depreciated 40%, that have low miles and are just incredible vehicles. There's a lot of them out there. But as far as a framework for the amount, that's a good question. I just feel that when we looked it up recently in an episode, I think the average car payment in America right now is $740 a month. That seems crazy to me because generally you need 2 of them. And I think $1,500 a month just for car payments for a family is a lot of money considering after that you have to take into fact insurance, upkeep, maintenance, gas, and all of that. So I think it's important for people to really understand the total ownership cost of the vehicle they want to buy, and then that way they can better figure out if it fits within their budget. As a general rule of thumb, though, the way I would look at it is take your net monthly income, and whatever 10% of that is the gross amount you should be spending on your car payment. I think that'll keep people in a good spot. I see far too many people that have these $900, $1,200 a month car payments, but they're only making $4,800 or $5,000 a month. That is just not a good idea.
Now, what about if in this situation where they're paying cash and there won't be a monthly payment, just like rock and roll?
In this situation, I think it's fine because they have a solid net worth and really good income. So I don't think spending that $30,000 or $35,000 is going to hurt them. I would just like to see them go with a little bit older car, maybe 2 or 3 years old, so they get more car for the money and less depreciation for them to absorb down the line.
I think it makes a lot of sense. Good question, Aaron, and wishing you the best of luck growing your new family. That's so incredible. So our next question comes from Joseph P. Joseph says, "Good afternoon, Robert and Austin. I hope all is well. Once again, I come with a question. For the past 3 years, I've been paying for custom whole life insurance. I pay $300 a month for a $300,000 death benefit. I don't know who I should talk to, but I feel like if I put that $300 in the market instead, specifically into the ETFs you guys talk about, and then just surrender the life insurance policy, I would be better off in the long term. What should I do? Thank you in advance and keep up the awesome work that you guys do." This is a really good question, Joseph. So as you guys know, we are big believers in term life insurance. As just another definition reminder here, the only reason that you have life insurance is if you pass away, the beneficiary that will receive that lump sum payment can then invest that money to offset your income now that you are gone, right? So let's say you're married and your husband's over here making $100,000, $200,000 a year. They have a life insurance policy of $2 million. They unfortunately pass away. The wife receives a $2 million lump sum payment. She is able to invest that into the markets, and she can safely take out 4, 5, 6, 7%, whatever she needs, to then supplement his $200,000 a year income, right? So like that is what life insurance is specifically for. And if you have that much in investments, technically speaking, you don't need life insurance because you can just take it and invest it anyway. But if you're like me and you're just like building your wealth and doing all that stuff, it's a good idea to always have that term life insurance. So in this instance, you're saying, hey, I've got this whole life insurance policy, which has like a cash value and a investment portion and like all these other different little things. For perspective, I have a $2 million life insurance policy, term life insurance policy. I think it's like 15 or 20 years. I got it through Prudential. It's about $100 a month. $2 million, $100 a month, 15, 20-year term. You've got a $300,000 at $300 a month. Do you see the difference there, right? 2 million for 100 or 300,000 for 300, right? It's like there's a lot of fees and weird assumptions that are baked into this whole life insurance policy, and the only way you can get your money out before you die if you're going to borrow it, all this weird stuff, right? So yes, you should surrender the policy, take the cash value or whatever you have left here, go invest it in the markets, earn your 7, 8, 9, 10, 12%, and then take that same $300 a month that you were paying toward this life insurance policy, add it, right, to that same brokerage account, same ETFs we talk about, and in the long term, you'll be better off 100%.
Yeah, I agree totally. In my experience, when I think of whole life, I think of higher fees, the opportunity cost lost because you're not investing that money in the things we talk about every single week. You have high surrender charges. Let's say down the road, like we're talking about right now, you want to surrender this policy. The fees are really, really difficult. And one of the worst parts about the whole life policies that I've learned over the years is that the slow cash value growth is just not going to be very beneficial for you long term, and that's why I'd rather see you take this money and invest it in the S&P 500 through VOO, or maybe throw some QQQ in there, AIQ, because I think long term you're going to be in a much better situation overall financially unless you went with the term life policy. So it might make sense to do both. Get rid of the whole life, get the term policy, and then invest the rest, because the term policy is going to be a lot more affordable, lower fees, and just better long term.
And if you're looking for term life insurance, there's a link in our show notes below. Go to Shuriance.com/rich habits. They're who I use to find my Prudential term life insurance policy for millions of dollars. And they were a broker. They're not going to underwrite you. They just help you find it. It's awesome. 10 out of 10 experience. Shuriance.com/rich habits. Our next question comes from Jillian D. Jillian says, "Hello, gentlemen. I caught onto your podcast a couple months ago, and I've been hooked ever since. Thanks for what you two are doing, as it is life-changing information. I'm 38. I make $175,000 a year as an electrical engineer in Texas. I have $300,000 in a traditional IRA, $30,000 in a bridge account, and 6 months of expenses in my emergency fund. I just landed a new job, and they're offering a Roth 401k. Do you recommend that I enroll in that, or do I continue to contribute to my traditional 401k? As a high income earner, some of the language around tax benefits for a Roth account are confusing. I appreciate your feedback. Thanks in advance." This is such a great question. Let's jump into it, Robert. So just so we're on the same page, there are two variants to your retirement accounts. There's the Roth variant and the traditional variant. The traditional variant is pre-tax. The Roth variant is after tax. So let's walk through what that means. Pre-tax means any dollar that you contribute to the traditional 401k, you are able to offset that against your taxable income whenever you're filing for your taxes. Where the Roth 401k, you are not able to do that. So then if I'm not able to save on taxes on my contributions, why invest in a Roth 401k at all? Good question. Every dollar you take out of the Roth 401k in your retirement years, so after the age of 59 and a half years old, is tax-free, compared to every dollar you take out of your traditional 401k in your retirement years is taxed as ordinary income. So either you get the tax benefits now with the traditional 401k, or the tax benefits later with the Roth 401k. Robert and I are always telling people to do the Roth variant of any retirement account. If that is a solo 401k, a normal 401k, an individual retirement account, whatever your retirement account is, we always think the Roth variant is the best way to do it, because we cannot predict what the tax brackets will be in 20, 30, 40, 50 years from now, right? You rewind the clock and you can see that peak tax brackets back, and I think it was like the 40s, Robert, were up to like 80 or 90%. Then they were up in the 20, 30, 40, 50%, and they're coming back down. Like, there's a bunch of different variables here. I have absolutely no idea who's going to be president, who's going to be in control, what's going to happen to tax rates in 20, 30, 40, 50 years. So if I can just say, you know what, I'm going to pay my taxes now, and I'm going to make sure that that money in the future is going to be earmarked as tax-free income for my retirement, rock and roll. So that's my answer here. And just to give you a little bit of perspective, if you did decide to stick with that traditional 401k because you mentioned as a high income earner, some of the language around the tax benefits are a bit confusing, and you maxed out that traditional 401k at $23,500 in 2025 at a blended 24% effective tax rate, you'd be saving about $5,000 per year at your income level of 175,000. That's 5,000 saved today, but you still have to pay ordinary income taxes on this money as you take it out in your retirement years. I like to do the opposite. I like to pay my taxes now and not have to worry about it in 30, 40 years.
I agree with Austin, and I think we should pause the internet for a moment after that masterclass because so many people get confused. And Austin, you always break that down so well for our listeners. So before we get into our next question, listen up, folks. You can lock in a 6% or higher yield with a bond account on Public. But remember, your yield isn't locked in until the time of purchase, so you might want to act fast. Lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds only at public.com/rich habits.
All right, Robert, our next question comes via Instagram DMs from Shelly B. Shelly says, "Hey guys, my name is Shelly and I recently started listening to your podcast. I love it and it's super educational. I'm 34. I have about 120,000 invested across all of my retirement accounts. I felt as if I was doing a pretty good job, but now I kind of feel behind for my age. Most of my accounts have been in mutual funds and I've never touched them or even really looked at them over the last 10 years. But after listening to your show, I began rebalancing, investing into some of the ETFs and single stocks you guys talk about. I started looking at my IRA and I realized that I'm in 5 different mutual funds that a financial advisor recommended years back. My main question is, do I need to be in all of these mutual funds?" Robert, what do you think about Shelly's situation, specifically with an IRA? Does someone need to have mutual funds? Could they stick to ETFs? What's your take?
My take is always, I want my money growing as inexpensively as it can be, and mutual funds generally underperform and have higher expense ratios and fees associated with them. So for me, it's always going to be these low-cost ETFs and index funds we talk about, and especially in this situation, because Shelly, she's younger and she's got a long investing horizon ahead. And so for me, I would migrate out of those mutual funds, get myself a diversification of 4 or 5 of these ETFs and index funds and call it a day. But the big thing for me, the big takeaway here is I am so glad that Shelly is following along and actively watching her money. So many people, I see it every single day, they just have all these funds. They don't know why. They don't know what they do. And they're trusting some random advisor to tell them what to do with their wealth. And they're not even paying attention. I've asked people multiple times every single month, what do you have invested? What's it invested in? What is your weighting? What are the expense ratios? They don't know any of this. And then that just means they're not keeping their eye on the prize. So in this instance, I would definitely migrate away from these mutual funds, get into those ETFs and call it a day, because she'll make way more money, have less fees going out, and she'll have her eye on her money, because we want to make sure everyone is actively managing their wealth.
Yeah, Shelly, I'm going to log into my Roth IRA right now on my phone here, and I'm going to shoot you straight. I'm going to tell you exactly what is inside of mine, and I can tell you without even logging in, I don't have any of these mutual funds that you're talking about inside my Roth IRA. 60% of my Roth IRA is in VOO, the S&P 500. 30% is in QQQ, the NASDAQ 100, and 10% is in Bitcoin via NEOS BTCI ETF, right? So those are the 3 holdings I have in my Roth IRA. Got a little bit of Bitcoin, got some NASDAQ, got some S&P, and we're off to the races. You don't need these mutual funds. You don't need to be paying 60, 75, 85 basis points per year just to underperform the markets. So I'm so glad that you are taking a look at your money here. At 34 years old, you're not behind at all, Shelly. You're doing a wonderful job, 120,000 invested. You've got your base built. It's incredible. So we're rooting for you, Shelly, and you're doing a really, really good job. So our next question comes from Julie. Julie says, "Hi, Austin and Robert. I'm Julie. I'm 25 years old and I live in California. I started listening to your podcast a few months ago. It's been incredibly helpful. Thank you for breaking down personal finance in such an approachable way. Right now, I make $28 an hour and my main expenses are rent and a brand new car payment. I recently opened a Roth IRA and an individual brokerage account after finally starting to learn about investing. I have $20,000 in my high yield savings, and my question here is, should I focus on putting more toward retirement so my money works harder for me, or something else? This is a great question. Robert, what's your take?
My take and my first red flag is new car payment. You're 25 years old. We just talked about this. You don't need to have this brand new car payment. It's going to eat away at your chances for saving money and building towards wealth. And the answer for me is yes, yes, yes. You should be focusing on living lean and mean at 25 years old, not having the brand new car, not having all the finer things in life, because the goal here is to get that base built, that 100K base, and get you saving and investing for your future. And it starts right now by not living beyond your means with the new car payment, because we'd love to see you have this Roth IRA set up, having as much as you can, 15, 20% of your net monthly income going away to this Roth IRA every single month and getting yourself diversified and built for your future. And it doesn't start by having a brand new car payment on a depreciating asset.
Yeah, so not working any overtime, right? You're making about $58,000 a year, assuming you do pick up a little bit of overtime, or you listen to Monday's episode, which was all about frictionless, effective, low-cost side hustles. Maybe you could make an extra $200, $400, $800 a month. That would really move the needle for you. But Julie, if I were in your situation, I'd do a couple things. The first one is I would stop contributing to this high yield savings account. You've already got that emergency fund saved. No need to add more to it. The other thing I would do is make sure I'm doing everything I can to prioritize maxing out that Roth IRA. $7,000 a year, $580 something a month, right? That is the priority. And if you're saying, wait a second, I can't afford to max out my Roth IRA, then what I need you to do is have a hard look in the mirror and look at that honest budget and figure out what needs to go. I had the exact same situation when I think I was like 23, 24. I was just around your age. I was making $62,500 a year, so just about the same you were making, but I had a monthly car payment of $440, and I had a monthly car insurance payment of $275. Right? So all in, that was $715 a month I was putting toward owning a depreciating asset. Why was I owning this asset? Because I thought it was cool, because I thought it'd make me feel good. I thought that was the thing to do when you get a job. Turns out it was a terrible mistake. I sold the car. I bought a 15-year-old beater. My car insurance went down like $150 a month or something, from like $275 to like $130 or something. So I was saving a bunch of money now, and that was that margin, that difference there is what I started to use to begin to make sure that I was maxing out my Roth IRA. I made that decision. I swallowed my pride. I said, I don't need this. I'm 24, 25 years old. Julie, if you can't afford to max out your Roth IRA, I would argue that maybe you should also get rid of your new car payments. Probably the best way to move forward there, right? But Julie, at the end of the day, personal finance is personal. We can only tell you what to do. We can only give you the math. We can only lead you in the right direction. It's you that has to look in the mirror and say, why am I doing this? Why do I drive a new car? I don't need this. I can go buy a $7,000 clunker like Austin did and drive that. It was a 2000, I think so I bought it in 2019, 2020, something like that. 2019, I think. It was like right before the pandemic happened. Robert, here we go. It was a 2004 Lexus ES 330. And the thing about it was I was able to buy it from a very old person who bought it brand new, by the way. They were in their late 70s and decided they couldn't drive anymore. And so I got a screaming deal on it, about $7,000 is what I paid. But here we go. Ready? The back seats didn't seem like they were ever sat in, and it only had 65,000 miles on it, despite being a 15-year-old car. But again, listen, you can find that stuff. You just have to put in the work to go and find it. Julie, you're doing a great job, but really consider finding those things in your budget that you don't need. Car payment could be one of them. Prioritize that Roth IRA, build your base, and then make a decision as to, hey, what's my next move? Do I want to start saving for a down payment on a house? Do I want to, what is that next thing?
I could talk about this all day, every day, and that is lifestyle creep in this instance is getting in the way of your future dreams. So many people just continually upgrade their lifestyle as they make more and more money, and they never get off the hamster wheel to allow themselves to set aside that money for the future. So I love this breakdown, Austin. And yes, all of you, consider your budget before you go out and buy that new car, because it is a depreciating asset, and we don't want to see you get buried in debt.
Robert, it's so funny. I'm on Carfax right now looking at the same car. And there's a bunch of them still for sale in my area. And they're all like, there's a ton of these that are under 100,000 miles. Like, for example, this one's got 59,000 miles on it. It's for sale for 8 grand.
Yep.
This one's got 82,000 miles on it. It's for sale for 9 grand. I'm telling, maybe this is the clunker y'all need to be driving like I did if you're trying to find an affordable, old, reliable used car. All right, Robert. So our next question comes from Isaiah. Isaiah says, "Hey, Robert and Austin, I love the show. Thank you so much for the hard work you guys do to get such valuable information out to the public. I do residential repair and remodel. I'm a 1099 worker, and back in 2024, I bought a 2009 Tacoma as a work truck, but it recently blew a head gasket. It's going to be an expensive fix, and I don't think it's worth repairing since it's a pretty old truck, but I've heard about this 100% write-off and bonus depreciation thing going on right now. I've been considering buying either a new truck or a used truck that is a lot newer and more reliable. Can you guys explain these new tax laws, and is it actually a good opportunity to buy a truck that I could potentially have for 10 to 15 years? It seems in the trades, everyone has something to say about finances, but they're also all just drowning in debt. So I want to make sure I'm not steering the wrong direction. Wanted to ask you guys first. All right, Robert, walk through both section 179 and bonus depreciation, because they're two separate things that Isaiah should be considering as it relates to buying a work truck that's used specifically for business purposes that will be titled to the business.
Yeah, I love this question. And Isaiah, I am so happy that you're thinking like this, because I see so many people in the construction trades that they go out and buy that brand new Sierra, that $80,000 F-150, and they just have all this expense and, like you alluded to, a lot of debt. In this instance, I think you should consider buying a used truck that's maybe 2-3 years old, avoid some of that massive depreciation in the first couple of years, and then look to do maybe the bonus depreciation is probably more your friend. And just make sure you read up, talk to somebody, if you have an accountant or a lawyer or whatever, to make sure you're doing it right. But the bonus depreciation is really cool because you can write off 100% of the vehicle in year one, as long as it is qualifying. What does that mean? You have to use it for business. You have to prove you use it for business, and it has to be in the business name. So make sure you understand that. If you have this business, this LLC or an S Corp, you need to make sure it is titled in that company to be able to get this depreciation. Now, secondarily, you can look at section 179. That one also is a very friendly in the big beautiful bill, and it allows you to deduct other business expenses or any qualifying vehicle over 6,000 pounds. The difference here, and one of the things that Austin alluded to, and I'm going to have him break it down a little bit better, is that with section 179, and I don't know why people aren't talking about this, you can only write off the amount of what your business makes per year. So if, let's say, your business profits $60,000 a year, but you're looking at an $80,000 truck, you can't get the entire write-off because it's based on the profits of the company.
That's right. With the section 179, you can't create a loss for your business by buying equipment or whatever and writing it off that way, but you can when you bonus depreciate. And what's cool about bonus depreciation as well is it's about the purchase price. It's not about the cash outlay. Right? So let's say, for example, you bought a used truck that was $30,000 and you put, I don't know, $3,000 down on the loan, and now you have a monthly payment of like $500. Let's say you do this in 2026. So total cash outlay for the year of 2026 is $9,000, right? $6,000 for the monthly payment plus the $3,000 down, $9,000. But it's about the purchase price, not the cash outlay. So you're actually able to write off $30,000 against your taxable income, not just the $9,000 that left your bank account. So it's kind of cool, right? It's a cool way that you can keep money in your bank account while also writing off more. It's very interesting, definitely something to explore. But please remember, we are not certified public accountants. We are not CPAs. Go talk to a CPA, go talk to a professional, get the right people in your corner to help guide you through this. With that being said, I've done this, Robert's done this, we've all done this. It's a great way to offset some taxable income in the future. So our last question comes from Brett on Instagram. Brett says, "Hey guys, I love the podcast. What are your thoughts on the talk of a possible AI bubble, and how would you hedge against it? Thank you so much for your great podcast." We've talked about the rumblings of an AI bubble on the Rich Habits radar, and I even think podcast episodes here of the Rich Habits podcast are Monday episodes before. But here's the quick and dirty. We are, in my humble opinion, experiencing this AI productivity boom, We're seeing GDP tick higher despite this government shutdown, which I think is just going to come and go. But we're seeing GDP tick higher. We're seeing a lot of corporate profits move in the right direction. The Magnificent Seven, their earnings per share are expected to grow by double digits in 2026. The S&P 493, they're expected to grow by high single digits, mid to high single digits in 2026. There's a lot of things happening behind the scenes that are saying, yeah, corporate profits are ticking up and to the right because of artificial intelligence. It's making us more efficient, more productive. We don't have to have so many employees. We just saw the Amazon layoffs. We saw UPS layoffs. Like a lot of companies are slimming down because of the productivity that comes with artificial intelligence. And a lot of companies are experiencing so much, hundreds of billions, if not north of $1 trillion of capital expenditures will be made by these Magnificent Seven companies trying to build out their AI infrastructure. If it's data centers, if it's employees, if it's manufacturing, there's a lot of things being built out right now. And as you go spend hundreds of billions, if not north of $1 trillion of expenses across, 7, 8, 9, 10 companies, the 10 largest companies right now in the S&P, that, let's call it $1 trillion of CapEx, capital expenditures, is revenue for other companies. So that's $1 trillion essentially of revenue that's now being spread out all across the country and the world. But that's revenue that's going to float to the bottom line of a 493 company, right? It's like, that's how I like to think about it. But at the end of the day, yes, there are bubbles happening that are AI driven in sectors of the market. We're seeing this a lot with the pre-revenue companies like space exploration, quantum computing, nuclear energy, right? There's a lot of names that have AI relationships, right? AI related names that are in bubbles because people got way too excited too quick. It's really hard to tell the difference sometimes between a company that's like, whoa, is it in a bubble? Is it not? What's the how's that going to look out? So now you're asking yourself, okay, well, what do I invest in as it relates to AI so I can have exposure? We think AIQ is a great ETF. QQQ is another one. IVES, the Dan Ives AI 30 ETF is pretty good as well. Or just the NASDAQ, right? Just VGT, things like that. But now you're saying, okay, well, how do I hedge against this? What if there is a big AI pop and a big bubble? I think healthcare right now is really beaten down. So if you're looking to add some diversification to your portfolio to get away from the AI stuff, one, real estate, and this is not in any order. One, real estate, two, healthcare, three, Berkshire Hathaway stock, right? Just not tech, right? What are things that are untech related that you can add exposure to your portfolio so that if things do start to come and get a little wonky in 26 or 27 or whenever this bubble will eventually pop, how do I have not so much exposure to it? You could also perhaps do some precious metals, but we've seen gold go vertical with silver, so I'd argue those are also in a bubble, but who knows? So I would really just move away from things that have experienced these crazy run-ups, which means Berkshire Hathaway, healthcare, some real estate, right? Things that are historically undervalued right now.
I love that takeaway. And I would say this, and I've been doing this for 40 years almost, and that is in all of these secular growth trends, like Austin alluded to, this is such a massive, massive uptick for this emerging tech called AI. And as that happens, there's always going to be bubbles within the sector. Doesn't mean that the entire sector is in a bubble. It means that there are a lot of companies that are riding the hype, riding the AI wave. They're pivoting their business model to say they're an AI company so they can get a piece of the pie, but it doesn't mean that the entire AI sector is in a bubble. I don't believe it's in a bubble. Austin doesn't believe it's in a bubble. There are bubbly companies within it that are built on hype cycle and not on revenue and profits. So keep that in mind, diversify properly, and I think you'll be fine because, in my opinion, I believe the AI sector has a long way to go. It always comes back for me to that you have to think of it as, bears sound smart, bulls make money. We have printed and printed and printed so much in gains over the last 3 years riding this AI wave, and I will continue to do so because I believe if you're investing in the best of breed in these secular growth trends, you're always going to win. That's my takeaway.
Well, I want to also unpack this a little bit more. I think it was Mark Andreessen who was talking about and comparing some sectors of this AI market right now to pets.com back in the .com bubble. Back then, pets.com, and again, I wasn't this is me just kind of reflecting on it. Maybe Robert knows more about the company before they went under, but pets.com wasn't making a profit. They were just we're just going to be internet pets and delivery and all this other fun stuff, like whatever, right? So pets.com very much ended up going under because it was just too early. But now, and this is what Mark Andreessen was talking about, you look around, every year about $10 billion is spent on pet care e-commerce, right? So think food, medication, supplies, treats, stuff like that. $10 billion a year on this like online pet stuff. So if pets.com had to go under for 10 billion now a year to be spent 20 years later, 25 years later, like what companies are going to go under now because of this AI bubble and people get excited, but then we fast forward 10, 15, 25 years into the future and like a better iteration of that is still going to exist. So it's like it's so weird because we're forced to bet on specific names and bet on specific companies versus having the opportunity to just bet on a secular growth trend, right? Online pet delivery, e-commerce, marketplace, whatever, is like a secular growth trend that has grown to $10 billion a year over the last 25 years. Like, what is that happening right now with AI that despite pets.com going under, right, that trend still went up and to the right and is now what it is today with billions of dollars. So like, there's probably things that are going to go under with this like AI, pre-revenue, no revenue, whatever. Like, I don't know if it's nuclear reactors. I don't know if it's data something. I don't know if it's, whatever. But like there are things in this AI bubble that we're experiencing that likely will go under. And a lot of people are going to lose a lot of money. But it doesn't mean that the technology is wrong and that they're operating in a wrong segment. It just means they might have been too early. They didn't execute properly or whatever. It's really interesting, Robert, to compare, right, the early pets.com to like, hey, they had a good idea, right? If they only fast forward themselves 25 years into the future, they might be doing billions of dollars a year in profits.
Yeah, I think that is an incredible takeaway of just getting people to understand better, because we do live in a hype cycle. Like if you think about like right now with the personal aircraft and the Archer aviations and all of these, and you also look at the nuclear reactors, we don't know if this is going to scale the way we believe it is, but there are going to be some bubbles in these sectors like pets.com. So I totally really enjoyed that takeaway because I think it's important for people to understand that yes, there's a lot of hype, but you want to try and invest in the best of breed and the companies that are actually, getting the contracts, building the revenue, building the profits, so you can have these really good opportunities for investing down the road.
If you like it when we talk about the markets and different things like this, you're going to love our Friday episodes of the Rich Habits Radar, where we talk about this stuff all the time. So be sure to come back tomorrow and listen to that Friday episode. And thank you all so much for your patience. Last Friday, we were in New York City. We got invited by Google Finance to learn more about their cool new product. So definitely go check them out when they're ready to launch that. But long story short, we're grateful and look forward to hanging out with you guys again tomorrow for our Rich Habits Radar episode.
And don't forget, for any of you that haven't joined the newsletter yet or checked out the 7-day free trial for the Rich Habits Network, they are in the show notes below. And we just really appreciate you all stopping by each and every week and enjoying these Q&A episodes, because we love making them right off the dome and doing our best to just share as much value as we can to each and every one of you.
That being said, be sure to come back tomorrow. Thanks again, and we'll see you then.